Tim, how we doing?
I'm well, thank you. Welcome back. That's a pretty bold statement to say everybody's favorite because it's
Yes.
probably not everybody's
Even
favorite.
people that don't tune in, they need to figure it out. Market Structure Mondays, baby.
We've got a brand new background here, though, and I have no idea where you are now. Sometimes you're at the lodge, sometimes you're in a hotel, sometimes you're at, where are you right now?
Is Tim Quast?
I am at our Denver house.
Denver,
baby.
Yeah.
It's all
Where
about
are you,
it.
Mitch? How far are you from Denver?
I'm in Charlotte now, but I still cry about
where were you? I forgot.
Dennis, you better lay off to the markets today, man.
But where were you? Okay, but he's Colorado forever.
I was Colorado Springs.
Where were you?
Denver. I was in Colorado for about like 2 or 3 years. So
I know.
I enjoyed it. Trust me. It just got too expensive, man. That inflation, it gets you.
It is a very expensive city. I agree.
Yeah. If you hear Tim say, you know the deal.
Tim, is there a different dress code at your house than you had at other places here? Because I see you got the sport coat on.
Snazzy. Looking snazzy.
Karen requires that I wear a jacket here.
Oh,
trying to keep
Karen keeps
the standards. No, I'm about to do what you were doing, Mitch, and so I'm headed to Santorini, Mykonos, sailing off of Corfu, tripping around Athens and Delphi and Meteora. You could do this too.
Pinkies up, baby.
If you use market structure, Ed, yes. So I figured I better dress up because I'm going to be out. I'll be out. I won't be back till the 24th of May. So you guys are going to have to carry the market.
I don't know what we're going to do without you.
Yeah, I mean, I'm just gonna have to use your data.
I didn't get a written permission slip or anything from you here.
Yeah, we didn't get.
We'll talk about this after.
Okay. There'll be some reprimanding.
All right, let's get into the markets. Let's take a look, and of course, let's take a look at. Forget U.S. stocks. What about the Caribbean? I was out there in the Caribbean. What about it, huh?
That's where you were, right? Where did you go? Where'd you go?
I went to Honduras and 2 Mexico spots.
Okay. You were on the west side of the sea.
On the west side, on the west side. I went through the Gulf. I went out of Galveston.
Okay. Nice. Well, I don't know if should we just forget the U.S. market? Is it do you go away in May, you guys? Do we just buy real estate in the Caribbean instead?
Maybe. Joel, you getting ideas? Joel's gonna be in the Keys for the rest of the month. You know it. He's going away. All right, Tim, let's get into it. What are we looking at? Of course, we got the bank disasters continuing here. FRC finally goes away. Yeah. Should we start looking at maybe some of the bigger banks after this? What is it showing up in the data?
Well, it's a large question. I'll tell you how I think that traders. So you as edge users, how do we approach this? And I will show you what I would do, because I don't know bank financial statements. Bank accounting is unusual, and I'm not going to profess to know who's in bad shape and who is not. But the good news is you don't have to know that as a trader, at least from a supply demand perspective. And you might have other ways to think about this. I've got Deckers up. Here's why Deckers has done so well. So long as stocks are above 5 and supply is falling, they rise when those conditions reverse. And that's really what you want to look for. If for Deckers, if demand drops below 5 and supply reverses to rising, it's still very high. This could stop rising at any point. But that's what you look for. And I would say the same thing is true of banks. The beautiful thing about market structure, the regulations and mechanics of the market that determine how prices are set, is that it reflects every known motivation. So you don't have to know bank financials. You can look at what everybody else knows by looking at supply and demand in financials. And one of the things that I will do, I do this routinely, is just go to the financial sector. Let me zoom this in a little bit. So this is 30-day demand and supply. So demand is now back below 5. Supply is not bad. I mean, you look at this and say, there isn't an indication for this group of over 530 stocks that would suggest that there is imminent trouble. But you could go into the sector and then do this. Look for how many stocks in this group have supply, short volume. Short volume is the supply chain of the market. It's the data set associated with the modified uptick rule put in place by the SEC in 2010. Then FINRA regulated to that, and it requires broker dealers to report whether the trades that they're executing involve shares that are owned by the broker dealer or its customer, or have they been borrowed, and market makers can create stock. So here's a little bank out of South Carolina that is 100% short. I don't know if it's in trouble. It hardly trades. So there is more trading activity in banks because there's more focus on them. And so if there isn't a real buyer or seller, market makers will manufacture supply. But it's a great way to look at it. You can look at the accumulation of heavy shorting in banks and have a pretty good idea what kind of risk exists. And I would say we're a ways away.
You know why that's 100% short is there's literally a trade by appointment only. And so what a market maker does is they basically meet that difference between when a buyer wants to buy and a seller wants to sell. There's a time difference there on really small stocks. And because this is trade by appointment only, meaning it hardly trades at all, the odds of a buyer coming in really at the same time as a seller here is almost zero. So that's where you have the market maker intervention here coming in to make up that difference. So basically, every time somebody's wanting to sell this stock, it's almost always going to be a market maker on the buy side. And every time somebody wants to buy the stock, it's almost always going to be a market maker shorting it to them on the sell side, which is why you see that short volume so high. So I just wanted to clarify, because some people are thinking people are positioned here on the short side, and that's not the case. This is just a market making phenomenon. Am I correct here?
Well, you're an expert on.
You are too, Tim. That's why I like to default and just make sure that I'm on the right path here, because this is just my thought process. I have no inside information on that. There's a market maker that actually did short it, but my logic here says that's why we see that.
You're absolutely right. The interesting thing is it's skewed. It's much greater than what it hasn't historically been 100% short, at least not all the time. So this is looking from year to date for this particular stock. And I'm sorry, I'm on my Microsoft Surface here instead of my larger laptop. But you can see that it's been an issue since January options expirations, basically back here. And the trend has continued to rise. It is absolutely, as you described, it is trade by appointment only, 1,500 shares a day. If you want to buy any amount of it, a market maker is going to have to short it to you. There's no question about it. But I think the fact that it's where it is does reflect, and this is an old bank. This bank's been around since 1924. It's not like some fly-by-night outfit. It's a small bank, regional bank. But that it is so high does tell you something about the mounting attention being paid to these things. Something to keep in mind. This is just a general observation that the Dodd-Frank regulation in 2010, and this is not my own thought. This is, Jay Clayton, Gary Cohn, and others have talked about this. Gary Cohn, former CEO of Goldman Sachs, Jay Clayton, former head of the SEC, that Dodd-Frank put a moat around 6 giant American banks who are going to, over time, absorb everything, just like JP Morgan did. I'm saying, absorb everything, because there will always be the buyers of last resort, because the government has effectively guaranteed 6 large banks capacity to absorb failures like First Republic Corp over the weekend. And by the way, JP Morgan did not take the debt or the equity. They took only the deposits and the assets, and they
took the good stuff
for it, right? So the point out of that is what? Well, ultimately, it's back to where you started, Mitch. You were talking about the consumer, Deckers, Crocs. The American economy and the global economy, the developed economy, is predicated on consumption. The U.S. government's balance sheet reflects the capacity of the consumer to service the consumer's debt and other obligations. Well, the US government's $32 trillion in debt. If you added the unfunded liabilities, it's over $100 trillion in debt. The larger question is, can we kite checks relentlessly to bail stuff out? Well, no. And at some point, this is going to become an issue. And I think if you're a trader, you should pay careful attention to this. Just watch the accumulation of shorting in the financial sector. Right now, it's not bad. There are banks of some size. You could look at, here's a case in point, Market Corp, 18 billion in market cap. It doesn't trade a lot either. 50,000 shares a day, 76% short. You will notice that most of these stocks don't trade a lot. But HWT trades, so this is Hancock Whitney, old bank. It trades 600,000 shares a day, 3 billion in market cap, and it's 74% short. I think there are signs that there will be significant trouble. But the larger concern isn't, to me, the regional banks. It is the American consumer. Do we have the capacity to continue to spend? And so as you trade consumer discretionary or stable stocks, you should keep this in mind, folks. Watch these sectors and the development of shorting. Look at consumer discretionary. It's not bad, but they're well over 50% short. Consumer staples, 50% short. Debt flatlining at 5. They're not great. They're not great. And I think that at some point, and it will catch us by surprise, nobody ever effectively predicts these outcomes, that we are going to have trouble with the American consumer, not the banks. Our ability to consume is going to be the trouble. So then what do you do as a trader? Trade diverging supply and demand that always exists somewhere. And that's the thing to focus on. I would say we're beginning to see a shift away from momentum. There are only 5 components in the momentum portfolio. The math looks for those. There are a dozen in low volatility. That's not a lot.
What are those 5?
Yeah, I'll show you. I'll show you who the 5 are. Let's go back over here. And they're not bad. I mean, if I look at these 5, they're all got good supply-demand divergence. This is what you look for, folks. Strong demand well above 5, and near term, the last 5 days, the last day, falling supply. Those are the things that produce, if you're willing to take gains, not chances, you can make 2% on those time and time and time again. Not 30%, but 2, stack it, 2, stack it. That's how you make money in this kind of market. Baxter, pretty good. It's weird to see them in this portfolio. I can't even remember Crown Holding. So Crown Holding is 9 with 45% short volume. Look at this, 40%, well below the market at 50, 31%, 38%. Even is that Mastech? So
Masco, yeah.
Yep, Masco, yeah. Masco. So there's some opportunity, but it's very limited.
You know what you're seeing, and maybe it's selective perception on my part, but we're starting to see some of the beaten down stuff that really hasn't participated start to rally. Comcast we were just talking about that one, and Charter. These are 2 beaten down names that have not been participated. They didn't have great earnings report, but they're buying them. I feel like you're starting to see Baxter is another one. I've talked about this on the show here. It's beaten down to a valuation level that's just ridiculous, to be honest. And we were talking about this in the mid 40s, and it continued to go down after I talked about it. Got down to 37. Well, it's back up to 47. So I feel like there is some bottom fishing happening in this market where people are starting to look down for what is beaten down to valuation levels that just, don't make sense anymore. And maybe the stocks have just gotten too cheap. I believe Baxter is one of them. I'm not a fan of Comcast, but the valuation level has been cheap for a long time here. Are you seeing other, examples of this, Tim? This is just me thinking here in the last 50 minutes. But are you seeing other examples of this?
Well, and there's a dovetail between, yes, we are. And I have not seen this big, what we could call is it moving from risk on to risk off? Is it moving from growth to value? I mean, the large tech stocks have been great, but they can be both growth and value. Remember, the largest single asset class in the world, folks, with over 40% of all institutional assets is passive large cap blend. And here's the thing, what's happened in banking is we don't think about, how are Bill and Sally Smith's finances, and are they able to service a mortgage? No, we take mortgages and we put them into chunks. and they become tier 1 or tier 2 capital. And so banks are like, well, I need a chunk of tier 2 capital. And we don't think about, well, what all is in that? And the US stock market is the same way. Most of the money in the market is trading it as a product or a price, not as a story. So if I need a product, and now the product called Microsoft, which I would prefer, or maybe Apple, man, we're running out of that product. So now I got to go to Baxter, which is still tier 2 capital. I'm making an analogy here. So I'm looking at the Baxters. There are utilities beginning to show up. If you look at the utilities from a sentiment standpoint, 90% of them are bottomed or rising now. And I think that is just money looking for large, like Sempra. Look for Sempra Energy. It's a giant utility that offers a big slice of a product called passive large cap blend that this money needs. Look at that. There's an exhaustion of the supply side and very steady demand. Well, that's the kind of condition that can give you a 2% gain. Take the 2% gain. You're just seeing what is happening with this big money that needs stuff. And by the way, it's new month, new money. I don't know if there'll be new money, but everybody's 401k plan, we do it. You only make contributions. We just made a significant contribution to the 401k profit sharing plan for our employees. Well, that gets deployed by advisors. We have managed accounts, and they're going to deploy that. And there are other people doing that, and that stuff will hit the market. And where will it go? It's going to go low volatility. It's going to go to bonds. Really, that's where it's going to go. It's not going to go into growth stocks. So that's because that's not where that money that wants safety goes. It goes into large, stable stuff. And the market is heavily concentrated. I've talked about this before. There are less than 500 large caps in the Wilshire Large Cap Index. There are 483. There are only 289 stocks in the Wilshire Mid Cap Index. And you put those two together, they're 92% of market cap. That's where the money is. And so you have to realize that, folks, as a trader, just go where the money is. Looking at low volatility again, if there's a supply-demand divergence with stuff at 5, all of these stocks are at 5, right in the middle. Bristol-Myers, Sempra, PPG, Coke, Brown-Forman, Applied Materials, Dominion. That's the kind of stuff where the money is starting to go. And so we can follow that.
Like always, show me the money, they say. And Tim Quast bringing it to you guys. Market Structure Edge. You guys check it out like always. Get your free trial. Appreciate you like always, Tim. Have a good time. And we'll see you soon, my friend. Enjoy the seas.
Thank you. Take care, guys. We'll see you in a few weeks.